Hello. If you're watching this, it means that you've subscribed to my channel. So thank you very much. Right, what we're going to do is get straight in to the balance sheet. Basically, what I'm going to do is I'm going to use that concept that I told you about in the introductory video. That so long as you can understand the basic math principle, that A plus B equals C plus D. You could also write it as A plus B minus D equals C. All you've done is subtracted D from both sides. And if you added D back to both sides, you'd go back to A plus B equals C plus D. So everything in accountancy is based on that very simple concept. The one side is balanced to the other side. And if you subtract something from the one side, if you added that same amount to both sides, a subtraction on the one side is equal to an addition on the other side. All right, so that's the fundamental math concept that we're going to use in the following couple of videos, is just to explain to you how accountancy works, so that you can realize it's not something up in the sky that you've got to have this massive understanding about. It's not at all. It's the most simple, basic concept that you could ever wish to imagine. So let's get started with it. Like I said, I'm going to start out with the balance sheet. It is, all accounting reports are important, but the balance sheet, in essence, is a snapshot of the financial status of your business at a specific point in time. So it's exactly the same as taking a photograph. At that moment, this is how my finances look in my business. And to help you understand what a balance sheet actually means, what I'm going to do first of all is create an imaginary person called Bob. And Bob, let's say, buys the house next door to you. And you know that Bob has spent $300,000 on that house. And when Bob moves in, brings in his furniture, and he arrives in a car. And you also know that that car is worth approximately $50,000. So as an outsider, as Bob's neighbor, you can sit and you can look at Bob living next door to you. And you know that the house is worth about $300,000 and the car is worth about $50,000. And if you add those two things up together, what you see as an outsider is that Bob is sitting with assets, things that he owns, in other words, worth about $350,000. But as an outsider, as a neighbor, you don't know anything more than this. And Bob himself obviously has got more information, or probably his wife or his partner, a couple of his friends. They know that Bob has either paid cash for absolutely everything, and then he's had available to him that $350,000 to buy these two items, or what is more likely is that he's borrowed some money from the bank to finance the purchase of his house and to finance the purchase of his car. And this is much more likely, especially when you're younger, it's a much more likely scenario in Bob's life, is that he's borrowed a bit of money, is committing him to working so that he's able to repay the installments of his finance. It's not a form of slavery, but it's committing you to working in your life while you owe money. Anyway, let's say that Bob applied for and obtained a bond over his property for $200,000, repayable over a 20-year period. And the same with his car. He applied for and obtained finance on his motor vehicle to the amount of $40,000. And then Bob also knows that he's got $10,000 in his bank. So that's Bob's financial situation. A house worth $300,000, but he's got a debt of $200,000 on that house. And he's got a car that's worth $50,000, but he's obtained motor vehicle finance to buy that car. Plus, he's got $10,000 in the bank. Now, if we sit and try and assess what Bob's net worth is, or his net asset value, in other words, how much money has Bob accumulated over his lifetime up until this point to help him purchase this house and the motor vehicle. What we'd have to do is to assess his net worth right now, or his net asset value, whatever name you want to give to it, is that the house cost him $300,000, but he's got a bond of $200,000. And the car cost him $50,000, but he's got motor vehicle finance of $40,000. But he's also got $10,000 in the bank. So to work out his net worth, what we'd have to do is add up his assets plus the amount of money that he's got in the bank, and then subtract the debt that he owes. And then we'd get Bob's net asset value. So in very simple terms, the house is worth $300,000 minus the $200,000 bond that he's got. The car is worth $50,000 minus the $40,000 vehicle finance that he obtained. Plus he's got $10,000 in the bank. So we're adding up all of his assets plus what he's sitting with in the bank, and we're subtracting his debt to get to his net asset value. And so on the screen, as you can see the formula, and in very simple terms, it leaves his net asset value as being $120,000. And that's the amount of money that Bob has managed to accumulate up until this point in time, saving it, whatever he's done. But that is Bob's net asset value. It's not the total of all his assets. It's a total of all his assets plus his bank minus his debt. Now, what I'm going to do, we can all understand what I've just said. That's looking at a person's personal financial situation. Now, in business, it works exactly the same. The only difference is that there are a couple of different terms that you need to understand. So what I'm going to do now is I'm going to change over to actually using my laptop, and I'm going to show you what a very simple balance sheet would look like using the same numbers I've just given to you for this imaginary person, Bob, but bringing in the terminology that we use in business. So I'm going to switch over right now. Right, what we've done is gone to my laptop so that I can actually show you some numbers. And this part of the whole story is actually the most important from a theoretical perspective. You know, basically the next couple of slides that I'm going to show you, if you can understand them, you've got the hang of everything. And basically, if you can understand these slides, everything else that follows is just a logical progression. So this is extremely important. And it's based on that concept that I've told you about a couple of times, that math concept, A plus B equals C plus D. So long as you can understand, you could write it the other way around. But by convention, throughout the whole world, is, from the accounting perspective, is the math concept is A plus B equals C plus D. There's no difference anywhere in the world. Right. So what we're going to do is we're going to base this presentation on the same person, Bob. We're going to use basically the same numbers. But what I'm going to do is just change those numbers slightly just to make it more business-like. So let's have a look. This is Bob's business, and I'm saying to you that he's got assets, and I've changed the land and buildings. These are now business land and buildings. From a house of 300,000, I've just changed it to 250,000, and I've added plant and machinery. Let's say that Bob is going to make something. He's still got a vehicle of 50,000. Let's call it a truck, and he's still got $10,000 in the bank. I'm introducing a new word here. You know, I've said debt up until now. I'm calling it liabilities. It's an accounting term. Any money that you owe is a liability to your business. So I'm sitting and I'm giving the same liabilities as before. The bond on the land and buildings of 200,000 and the vehicle finance of 40,000. So what we're going to do is the business, the simple math is exactly the same as how we calculated Bob's net worth. All right, so on that first line there, I've written land and buildings plus plant and machinery plus vehicle plus bank minus his bond on the land and buildings minus the vehicle finance equals the net asset value. I've given you exactly the same formulas as we spoke earlier to work out his personal net asset value. All right, so I've just thrown in the numbers there, $250,000 plus $50,000 for the plant and machinery, $50,000 for the vehicle, $10,000 for the bank, minus that $200,000 bond, minus the $40,000 vehicle finances, leaves that same value, $120,000. But now I'm bringing that basic math. And what I'm saying is you've got two negatives there, the minus 200,000 and the minus 40,000. And we could add to both sides of the equation those two numbers. So then what I'm sitting saying is when you add it to the left-hand side of the equation, those numbers are disappearing and they come in as positives on the right-hand side of the equation. So what you're going to end up with is $250,000, the land and buildings, plus $50,000 for the plant and machinery, plus $50,000 for the vehicle, plus the $10,000 for the bank, equals that net asset value of $120,000, plus that bond, and plus the vehicle finance. Okay, so it's just been a very simple mathematic calculation. All I've done is to both sides of the equation is added the two negative amounts. So when you're adding it to the left-hand side, it zeroes it. And when you add it to the right-hand side, it becomes a plus of those amounts of money. So what I'm saying, just to get you back to that A plus B equals C plus D, A, I said, is assets. B is your bank. It is an asset, but I'm keeping it separately. One reason is because bank is so important, is you can't run your business without any money. But it just helps me also alphabetically with this equation that I've written down. It makes it easy to remember. So A plus B is your assets plus your bank. And I've brought in a new term now. It's C. We've been talking net asset value, or a person's net worth. You've taken all of your assets and you've subtracted your debt. In business, we call this net worth capital. So that's where the C comes from. All right. Now, if I add up both sides of that equation, they're both totaling $360,000. All right, so it's in balance. That's the principle of a balance sheet. Very simply. Let's go on to the next slide. So now what I've done is I'm showing you Bob's business balance sheet as at, I'm making up a date, 31st of December 2000. Right, I know in America you write the month and then the day. Very confusing for me. 31st December 2000. And what I've done on this layout here, we've lost the equal signs and we've lost all the plus signs. Okay, we've just taken them away to make everything clean and simple. All right, so the left-hand side is the debit side of the balance sheet, and the right-hand side is the credit side. Now, again, this is just a name that the whole world has agreed to use. So these are things, like I said, what's on the left is on the left, and what's on the right is on the right. And the whole world has agreed to call the left-hand side the debit side, and the right-hand side the credit side. And very simply, all that you're going to do with everything on the left-hand side is add them up together to get a total. And everything on the right-hand side is you're going to add them up to get a total. So it's exactly the same as that math equation that I've told you about. The left-hand side is still A plus B, your assets plus your bank. And on your right-hand side is C plus D, your capital plus your debt. But now I've brought in a few other accounting terms. Okay, so I've broken the assets up on the debit side into what are called fixed assets and what are called current assets. And the difference between the two of them is that fixed assets are long-term assets. They're things that, as a rule, you will use to make your business run. That you're not making money out of these assets as such, you're using those assets to make you the money. So in the fixed assets, I've got the land and buildings, the plant and machinery, and the vehicle. You know, they all are going to be in use for at least 1 year, but in the examples that I've given you, your land and buildings are forever, basically. Plant and machinery is for at least 5 years, and vehicle for at least 5 years. Okay, so I've just broken that up so that when you're looking at a balance sheet, is you're splitting the different kinds of assets that you've had. So your fixed assets are your long-term assets. Okay, you're not trading with those assets, you're using them in your business. Your current assets are what you actually do use to trade with. Now, I've got a very, very simple balance sheet up at the moment because the only current asset I've got there is the bank account. All right, this is how we're sitting at the moment. Your bank's changing all of the time. Obviously, you can imagine it's changing multiple times a day. Every time you do a bank transaction, it's changing. So a current asset is very short term. Those are the things that you actually use in your business you trade with to make money. Then on the right hand side, the credit side, got your capital. Now, in this case, it's very similar to the net worth of the business. Can change to describe it a little bit better. Capital is what the owner of the business puts into the business. It could be cash, and then you go and you buy all of the things, like the land and the buildings or the plant and machinery. Or it could be the fact that you already own them, and you're putting them into the business at their current value. So it's not necessarily cash, it could be the physical things. So you could have sat there with all of those items, those fixed assets, and the current asset, just said, right, I'm going to use all of those things for my business. I already own them. And you're bringing them in at their current value. That's your capital, is what you've invested into the business. Or you could look at it in another way and describe it as what your business owes you at this stage. Another way to look at it, if you sat there and you sold this business just like it is at the moment, this basically, it's selling value. Things do change. It's not quite as simple as this. But this is the absolute basic of the story. And then I've broken up the debt into long-term liabilities and current liabilities. Okay, so long-term liabilities relate in essence to your fixed assets. How have you financed your fixed assets? So it's going to be, again, for a period longer than a year that you're holding this debt. So under long-term liabilities, we've brought in the bond against the land and buildings of 200,000 and the vehicle finance of 40,000. Okay, so summary of this slide really is on the debit side. What does the business own? And on the credit side, how was all of that financed? So the capital is your money, and the liabilities is borrowings, debt that you've incurred to finance your assets. All right, this is extremely important. It is this way around by convention, and all it is doing is obeying that math equation. A plus B, assets plus bank, equals capital plus debt. And that's all that you have to remember how a balance sheet is actually working. Let's go on to the next slide. What I'm just doing here is I'm just showing you some basic transactions. Actually, I just would like to go back. No, we can't. I'm just going to show you some basic transactions just to show you how to fix the balance sheet. So let's say you've got that $10,000 in the bank and you want to go and buy some stock. You can call it inventory, same name, well, say different name for the same thing. And I'm going to buy $5,000 paying by cash. So what will happen when you go and you do something like that is our stock value is going to increase by $5,000. But our bank balance is going to decrease by $5,000. And so I'm showing you the basic entry is to increase stock plus 5,000. Stock is a current asset. And if we debit the stock, it's exactly the same as plus the $5,000 because stock is on the debit side and we do a debit entry. It's the same as going plus to it. The bank entry on the other side on the other hand is a credit. And what's happening in your balance sheet is your bank is on the debit side. It's a current asset. Now I can minus 5,000 from it. And you're going to get your $5,000 in the bank account. Or to both sides of that equation, I can plus the $5,000. And I end up with zero on the debit side and a plus $5,000 on the credit side. for your bank. So if you've got a credit entry on your bank account, it's a payment. It's a minus. It's exactly the same as a negative from the left-hand side. All right? You can understand that. Make sure, think it through. So anytime you want to make a payment from your bank account, an accountancy, you're processing that entry on the right-hand side, on the credit side. It's exactly the same as a negative on the left-hand side or the debit side. And this is why I'm telling you, you've just got to be able to understand that a negative on the one side, I can just add the amount of money to both sides. I zero it on the left or the debit, it becomes a positive on the credit. So when your account is on the debit side, if you process on the debit side, you're adding to it. If you process on the credit side, is you subtracting. And that's how you process payments. End of story. All right, we're going through to another basic transaction. You've got your supplier and he sells you another 5,000 worth of stock on account, or it's also known as credit in accounting terms. Any transaction you do this, don't get confused that it's on the debit side or the credit side of your set of books. When you say you're doing a transaction on credit, it means it's not cash. All right, so again, we're adding $5,000 worth of stock. So it's stock plus 5,000. We haven't seen this in the balance sheet, but I'm creating a new current liability called your supplier. Collectively, they're also known as creditors. All right. And the creditors is also going to go up by 5,000 as you owe this person that $5,000 as you haven't paid for it yet. Okay. So I just want to show you the entry for that. Basically what I'm saying is your supply is a new account. It is a debt or money that you owe, and in accounting it falls under current liabilities. It is a short-term debt. So the entry, we're adding stock. So you debit stock. It's a current asset. And now we're creating a new current liability, your supplier, which is a credit balance. It's a debt, a liability to your business. And to add to that, we simply credit. Right, that should make sense. Lastly, just as a basic transaction, I'm sitting saying is that we're going to sell all of the stock to our customer for $15,000. And really what's happening, I'm going to introduce something that will be in the next video. It's a sales account. I will explain it. But to add to our bank, he's paying us cash for it as we debit the bank with $15,000. And like I say, the credit will be sales. Ignore that for the moment. I just want to change this balance sheet a little bit by making a sale. But I will explain it in the next video. But if we sold that same stock on credit, or in other words, we haven't received the cash from our customer is owing us that money. The opposite to a credit, the business owes money to. The opposite is a debtor, a person who owes us, the business, money. All right, and let's just call this person Mr. Smith. What would happen, because that's Mr. Smith as a debtor is also a current asset. It's on the debit side of your balance sheet. All right, so to add what he owes to us, we're debiting Mr. Smith instead of cash. It's exactly the same way around, but we're debiting Mr. Smith this time. And again, we're crediting sales. And like I said, I will explain that. one of the things that I always learned when I was at school, and I did very basic accountancy, it wasn't finished school subject, it was at the junior high school subject. I always used to imagine if a transaction was cash, what would happen? And then turn it into a non-cash transaction. Because cash is easy. Money into our bank is a debit. That's a receipt. Money out of our bank is a credit. And then you've always just got to find the opposite side of the entry. So it's quite easy. It's simple logic. Let's just go on to the next slide. So what I'm leaving sales out of the picture at the moment. What would these transactions have done to the balance sheet? Just to change that original balance sheet that we looked at. And we're only looking at current assets and current liabilities. Nothing's happened. And that's the general rule, is your long-term assets or fixed assets, I should call them, long-term liabilities. They don't change very often. It's your current assets and your current liabilities that are changing basically with every transaction that you do. And another story with current assets. They are all items that are relatively easy to turn into cash. Whereas your fixed assets, it's quite a story to go and sell your land and buildings, whatever. But stock, you can sell it quickly. Debtors, hopefully they pay you fairly quickly. What has it done? So the very first transaction, I'm sitting saying under current assets there, the bank on hand from our balance sheet earlier was $10,000. That very first transaction that we did is we bought stock, cash, $5,000. And you can see that transaction there, $5,000. It's the credit. Okay. And then under stock, I've created a new current asset there, stock, cash transaction 1. That's your debit side of that entry that I showed you of $5,000. So it's in balance. As your balance sheet is still in balance after these transactions. And then I've created creditor supplier. I haven't named the person. That credit transaction where our supplier supplied us stock and we've got to pay them later. Because that's that transaction 2 on the credit side under creditors for $5,000. And the debit side again is to the stock account. It's brought it in. So we're sitting there with $10,000 worth of stock. Okay, and at that stage we would only have 5,000 in the bank because the credit side is the same as a negative. Okay, then the third transaction that we created, again, ignore the sales side of the transaction, is I've just created now my debtors, customer accounts, in other words, and I've brought through Mr. Smith that third transaction, $15,000. He owes us that $15,000. All right, so that's very simply, I'm just trying to explain to you how transactions actually affect your balance sheet. And again, I'm saying it's using that simple math story. A plus B equals C plus D. And if you want to do the opposite, to reduce a balance, you transact on the opposite side. And if you want to add to a balance account, you transact to the same side. Simple maths. All right, I've just brought this up as a conclusion to this, because what I'm going to do is, as I go forward, I will come back all of the time to these basic points. I'm trying to start with the absolute basic principles. And as we go further, we go into things in that little more detail. Like I've said to you, I'm not trying to turn you into an accountant. I'm trying to help you understand just the background of what is going on. And it's my personal experience that when you understand something and you really understand it, you feel like you've known it your whole life. That fact, whatever you've just understood, it's like a spark shining in your head. Wow, I've always known that, even though it's just been explained to you. And this is what I'm hoping, that this very simple maths concept, change the word there to match, A plus B equals C plus D. So assets plus bank equals capital plus debt. That's the very first thing that I've taught you. And I've written there basically what's on the left-hand side, that A plus B, so the assets plus the bank, that's what the business has got. And on the right-hand side, the C plus D, it's how this was financed. So it's your own money is the capital, and the D is the debt or liabilities that you have incurred. So I've said to you, in accounting, we simply drop all the pluses and all the equal signs. So on each side, the left-hand side, the debit side, and I remember that as well when I was young. Left is 4 letters, debit is 5. It's the 2 shorter words. Right is 5 letters, credit is 6. It's the 2 longer words. That's how I just used to remember which is the left and which is the right. So I'm saying we drop all of the pluses and the equals. That equals you can replace with a line right down the middle of the page if you want to. But basically, we're going to add up all the accounts on the left, and we're going to add up all the accounts on the right-hand side, and they must be equal. Okay? And then what I've shown you, just by doing a couple of very simple transactions, there's always at least 2 entries to keep your accounts in balance. It has to be like that, as you have to do something to the one side and then the same amount of money to the other side. All right? And what is called in accountancy is the double entry system. Now, if you think about it, if you're running a very simple set of books, you wanted to just keep track of your bank balance, you could always just go plus however much you've received minus what you've just spent. That would be single entry. All right? Double entry is, we're saying, if we receive money, where did it come from? There's 2 entries. If we pay money, what did we pay it for? That's 2 entries. Okay, so accountancy works in the double entry system to keep it in balance. Now, just at this stage, the whole story with these videos is to explain to you, a business owner, prospective business owner, manager, somebody who's just interested, but you're not an accountant. The whole point of these videos is to explain to you how to understand accounting reports. All right. So I'm teaching these absolute basics. And really, what I've just said to you are the absolute basics. And if you understand this, there's almost no theory going forward, because everything going forward is based on this principle. So that's why I've labeled it quite a bit. It's based on this principle. You need to understand it. All right. So that is basically the theory that I'm going to go through with you. But now, just as a very simple story about say, understanding what you're reading when you look at a balance sheet, because it's telling you a story. It's a financial story. But really, it's just numbers on the left hand or debit side, and it's numbers on the right hand or credit side. And really, what you're looking at is when you look at a balance sheet, you're looking at, in accounting terms, how strong a business's balance sheet is. The stronger a balance sheet is the more assets that the business owns compared to how much debt it's got. So it would have very little debt and a lot of assets. That's a very strong balance sheet. If, on the other hand, you've got a lot of debt on the credit side and you haven't got that many assets, your balance sheet is getting weaker and weaker and weaker. Your business, therefore, is not in a strong financial situation. It's exactly the same as Bob, the individual. You know, you could see the house that he bought and the car that he bought, but you don't know how much debt he's got. If he had to pay cash for everything, very strong financial situation. But it is life. You're starting out as a young person. You have to borrow money to go and buy these things. And let's say that these numbers that I've put there on the balance sheet are very controllable. What you also have to do is when you look at a balance sheet, you can see assets listed. It might be your very own balance sheet in your own business. And you yourself know when you sit and you look at certain numbers, let's say your stock valuation, you might know there's a lot of stock there that you actually can't sell. You know, it's past its sell-by date. It's gone out of fashion. It's broken, whatever. And if you've got everything in stock for what you paid for it, but you know in your life that there's certain stuff that you could never sell, you need to write that stock off. It's not helping you at all. You know, you might be keeping it in your books to borrow a bit of money from the bank manager, but it's not helping you make business decisions by overstating your stock. And it's the same with debtors. If you've got debtors and you know that they've gone bankrupt, why keep them in your books? You must write them off because you're never going to collect that money. So for yourself, I'd say one of the very first things that you must do when you're looking at your own balance sheet is really look at all of those numbers that you're sitting there with there, like your stock, like your debtors, and decide whether they're realistic numbers. Because there's no point in having overinflated numbers in your balance sheet. You know, from a tax perspective, if your accountant agrees to write things off with you, it's reducing the tax as well that you're going to pay. But we'll go into all of this in more detail. It's in the next video. What we're going to look at is the income statement. And these two, the balance sheet and the income statement, are the primary reports that accountancy provides, accounting programs provide. But they are the two reports, as I explained earlier, that when you're sitting with your fist and you're listening to stories, they're just bouncing off. They're not going into the core, but they are telling you a story that you need to understand. And then we will get there. All right. Thank you very much for watching. Cheers.